What sticks out to you?
Well, there's not a lot here. That's not a surprise. They might have done more on the inflation side to dismiss some of the rise being associated with temporary factors like oil prices. They didn't. They took the simplest route. This is a summer FOMC statement. Let's just say inflation is near. That's good enough, and move on. So really not a lot here in the statement changes.
Let's bring in Diane Swonk. She joins us from Chicago. She's the chief economist at Grant Thornton. Diane, talk to us about what you heard in that Fed statement that sticks out at you.
I think the biggest issue is that growth is now not just solid, but it's strong, and acknowledging that both consumers and investment are picking up. This is very subtle changes. I agree with Jeff, but I think it sets up the stage for that leap in rates or jump in rates in September. We'll do another rate hike in September, and what we do is have plenty of time between now and then and lots of signals. I do think the dirt is in the details in the minutes, and I think there's going to be a lot of issues in the minutes, everything from trade, tariffs, what kinds of things they're hearing. We saw the ISM and the PMI today say, listen, tariffs are starting to seep through, and you will see increases in prices via tariffs in the third quarter. Right. So that's something the Fed's going to have to deal with next.
Diane, if we're going to see taxes, which I believe we call tariffs, is that going to fall mostly on goods inflation? Is the real story here, Chairman Powell has good deflation become goods disinflation, where we get outright goods inflation?
I think we will, depending on how far the tariffs go. We are going to already see, we've seen automakers announce that they've going to have to raise prices because of steel tariffs, aluminum tariffs. That's already getting factored in and filtering its way through. As we move into the third quarter, you're going to start to see those things happen. And, pointing to Jeff's remark about the oil prices, that will be a help for us, falling now instead of rising. However, the core inflation rate is held steady, and that's where you're going to see the price increases come through. Also in services, we know we're going to get some medical inflation that's going to come through in those service prices. So I think we are going to see an overall hotter inflation story than we have seen.
Michael McKee, what matters to the next meeting? What economic data will you be watching? Is it the inflation dynamic?
Sort of, Tom. I guess what everybody's going to be looking at next and will really feed into the decision in September is the Friday report. We used to call it the jobs report. Now I hear people on Wall Street calling it the average hourly earnings report. If we see growth in average hourly earnings that suggests there are some inflation pressures building, or as Diane notes, we get some sort of indication that we're seeing some inflation creep in because of the tariffs, then that would only solidify the idea that September is in play. But since Jay Powell told us that we're going to see further rate increases, there's no reason to think that September is not a done deal at this point. And really, December remains on the board as well, because we haven't seen enough of a slowdown anywhere to cause them to take that off. So until September, we're all probably going to be betting on the same thing.
So we keep talking about how September might be a done deal, that today's statement sets the stage for the next rate increase, presumably in September. I'm looking at WIRP Go, WIRP Go on the Bloomberg here, and the odds of a rate hike on September 26th are right now at 80%. Is the Fed, Jeff, comfortable with such a high degree of conviction for a September move?
I think so. I mean, where in the past they've been not comfortable is when the odds are too low and they want to talk them up. I think with 80% odds, this is a very predictable Fed meeting in the fall, both increases in the fall, and I think the Fed wants it to be that way.
What does the Fed want to see odds at for a December rate hike, if it goes there?
I mean, similarly, it wants the market to not be surprised. Like today, they want to get out of a meeting, they want to get out of a press conference without rattling the market, without tightening financial conditions more than the gradual pace of increases. So I think having these high probabilities of increases, the Fed's very comfortable with that.
Diane, when will the decision for a fourth quarter rate hike be made? Will it be made days before, the day of, or weeks ahead of time?
Oh, I think we're going to have enough data to justify it well ahead of that. We've got an economy that has a lot of fiscal stimulus in it via now the spigots on government spending are on, which will buoy growth in the second half. Some of the special factors that push growth up above 4% will peter out, but it's still about a 3% year. That's an acceleration in growth, and we are getting lower unemployment. I do think we'll see some wage acceleration. We are seeing benefits pick up, which is sort of a nice return for many workers to see that benefit aspect of it pick up. We saw that in the employment cost index as as well. The issue is, how complicated does it get with overheating for the Fed between a hot economy, a much more warmer economy, plus tariffs and taxes. And that's going to be a conundrum for the Fed. But I think the Fed has to react to economic conditions, and it will be very clear they're going to have to raise rates in December, not long after that September meeting.